the government's focus on scaling up domestic manufacturing in several strategic and frontier sectors augurs well for India's ensuing growth trajectory. On the demand side, private consumption this year is expected to be supported by discretionary spending. Rural demand remains robust. It should gain further traction on the back of favorable agricultural conditions and a healthy labor market. Urban consumption is likely to strengthen further, aided by the beneficial impact of GST rationalization and the buoyant services activity. While the government's thrust on infrastructure spending continues, the revival in private sector investment is expected to sustain on the back of high capacity utilization, strong credit growth, and benign financial conditions. On the external front, merchandise exports could be adversely impacted from disruptions to key shipping routes, the concomitant rise in freight and insurance costs, and lower global demand on account of the conflict. However, merchandise exports may benefit from the recent trade agreements, many of which were signed last year, and few of them are now in implementation, and others to become operational hopefully this year, while services exports are expected to remain resilient. Taking all these factors into consideration, real GDP growth for this year is projected at 6.9%, with Q1 at 6.8, Q2 at 6.7, Q3 at 7, and Q4 at 7.2%. Further escalation and wider spread of the conflict, as of now, of course, we have a ceasefire, heightened volatility in global financial markets and weather-related events, however, weigh on the domestic growth outlook. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict. Coming to inflation, in January, February, headline inflation continued to remain below target. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict. Coming to inflation, in January, February, headline inflation continued to remain below target. It was 2.7% and 3.2% respectively, with food group recording inflation. It was in deflation mode, as you are aware, in the previous 4 months up to December. Inflation in fuel terms was modest, core inflation at 3.7%, and the underlying price pressures benign, as evident from the much lower core inflation if you exclude precious metals. Turning to the inflation outlook, recent spikes in energy prices due to the conflict have emerged as a risk. Although retail prices of petrol and diesel have remained unchanged so far, the pass-through of higher global energy prices has resulted in some price increases in a few other fuel items. Food price outlook remains comfortable in the near term, with a robust Rabi production that we had, adequate reservoir levels which would help agricultural activity, and comfortable buffer stocks of food grains. The likely emergence of El Nino conditions could pose a risk. Considering all these factors, CPI inflation this year is projected at 4.6%, with Q1 at 4, Q2 at 4.4, Q3 at 5.2, and then going down in Q4 to 4.7%. Core projection is projected at 4.4%. We are doing this for the first time, as has been the demand from some quarters. And going forward, we we shall continue giving our projections for core inflation too. Excluding precious metals, core inflation is even lower, indicating that underlying inflation pressures are expected to remain contained. The risks are on the upside.